You're with us here on Ask Udayan, the show where we answer all your stock-specific queries. Every Wednesday, simply send in your question to the number on your screen and we'll select a key few to be answered by our global business editor, Udayan Mukherjee. Let's get started then. And then our first query today is coming in from Simla, and this one's to do with IPO allotments. And there's been a lot of furor, in fact, around that of late, with some investors very upset that they didn't get their opportunity. But let's listen in to this query coming in from Simla, Ritika Bakshi.
Hey Udayan, I'm Ritika from Shimla. I got one lot of Paytm shares during the allotment and now stock trading is around 1200 level. Should I sell now or wait?
It's good to hear from Shimla first. Always nice to hear from the hills. But commiserations, because it's not worked out so far, this Paytm business. Almost at 2000 an entry and now already down 40% at 1200. So it's been a big knock on the stock price. But frankly, the more one sees of Paytm, the less convinced one feels about the path to profitability. The big problem with Paytm is not its payments business. It's this transition that it's trying to make from using its payments business customers to financial services, the NBFC kind of business. And that path is not very clear. So far, they've not made major inroads into the lending business. And they're facing some other problems on the regulatory front with the recent regulations which have come in from the RBI. They are not very supportive for Paytm's model going forward. Also, if you look at the number of people who have left the company, the top brass, I think they're facing some serious attrition at the top management level. And that's not usually a good sign for a fairly newly listed enterprise. So some trouble seems to be brewing at Paytm. I know the stock has corrected quite a bit, 40% already, but selling now would mean converting your notional losses into permanent losses. I would say, since you're sitting on significant losses already, you might as well wait it out and see if Paytm can get its act together over the next 1 year or so. But in the interim, there is every possibility, I must warn you, that the stock will go down into triple digits, which is less than 1,000 rupees, which would mean a 50% markdown on the price that you got your allotment. So it could get even scarier from here.
Okay, so that's some advice to take into account when you're looking at Paytm. Nehal Rupani also has a query. She's from Ahmedabad. Let's listen in.
I have 150 shares of Mahanagar Gas at around average price of 1,025. And I'm holding it for more than a year right now. I would like to know whether the long-term aspect of the MGL and outlook of a gas marketing company overall.
The problem is that MGL was touted as this major gas play many years back. And, it has as since you're an investor, that it is actually a consumer play in the gas business with large circles in Mumbai and surrounding areas of Mumbai where it supplies CNG too. But it's just not worked out that duo of MGL and IGL becoming great wealth creators, that has really not played out. So the stock, I don't think the stock has really created any wealth in the last 5 years. It was 1,200 in 2017 and it continues to be grinding at around 900 in 2022. So in effect, it's not created any wealth at all. In fact, it's lost money for many shareholders. And right now, there are some challenges with MGL, which is that the price of LNG is going up, which is squeezing its margins. And therefore, profitability growth will be muted, I think, high single digit maybe for MGL for the foreseeable future. So between MGL and IGL, I would still say that IGL is probably your better bet. But I don't think these stocks will become major wealth creators given the dynamics of the business. You're probably better off exiting when you get your price back and looking at other sectors.
Okay, Arvind Choksi from Burhanpur has a query on Greaves Cotton, and we're getting in queries from all parts of the country, as we can see today. Arvind, go ahead.
Hello, Udayan. I'm holding 10,000 shares of Greaves Cotton at the rate 150 rupees. What's your view on Greaves as an EV player?
No, I think Greaves Cotton is an interesting story, and you've gotten at a reasonably good price point. You're already making money, but stock actually doubled very quickly a few months ago, and then in the last 6 months, it's just consolidating nicely in this 130, 170 kind of a price band. But you're still in the money, and I think you'll probably continue to do quite well because Greaves Cotton does many things. I mean, it's an engineering company which makes farm equipment and other equipment, but basically, from a stock market perspective, it has become a classic electric vehicles play because it makes these electric two-wheelers and three-wheelers, and that is where the management focus continues to be the thrust of its business. In fact, in December, they sold about 10,000 vehicles, electric vehicles, which has got the market very excited, and they're looking at doubling their capacity as well in Tamil Nadu. So I think as almost a pure EV play, if you want to look at it that way, I think Greaves Cotton makes a lot of sense because their initial forays have met with success. It's not terribly expensive for an EV company at maybe 28-30 P multiple on FY23 earnings. So if you're a long-term investor, I would say there's no harm in owning a proper EV company in your portfolio. Not a recommendation to buy, but since you already own it, I think it's probably a good one to hold on to.
It's interesting, Udayan, because a lot of investors are starting to track some of these much hyped themes. I mean, there is genuinely a lot of investment being put into the EV marketplace, but also ESG, for instance, is another theme that's much talked about. And investors are clearly starting to try and identify companies that are, actively pursuing the ESG agenda, for instance, or companies that could be, proxy plays on the EV theme, as we just discussed. Share with us whether you feel it's wise to go by these investments, just looking at themes as a fad vis-a-vis what the company is actually doing.
Sometimes these can be faddish, these investments, but sometimes they can be actually knocking on the doors of significant opportunity. So I think renewable energy and electric vehicles are probably not fads. I mean, they're probably very significant opportunities. We cannot see it yet because so much of our power in India is still thermal power, and we hardly see any electric vehicles on the road. But, in the next 3 or 4 years, which is the minimum horizon long-term investors should be looking at stocks from, I think these will become very powerful themes. And as I took pains to explain that sometimes you can overpay for an opportunity. But in the case of Greaves Cotton, and again, this is not a recommendation to buy it, you're only buying it at a 28 P multiple. This is not the same as paying 2 lakh crores for a digital company which does not make profits yet. This is a highly profitable company. So when you are playing, look at how well the Adani Group stocks have done over the last year and a couple of years. And some of them are focusing on renewable energy in a big way. So the market is sensing this opportunity and betting on companies which are already profitable and actually can become leaders in these emerging spaces such as renewable power or electric vehicles. So I would not dismiss them as complete fads and look at opportunities for profitable, well-run companies in the space.
Fantastic. And that's just it. Look for well-run companies in the space. And yes, these are perhaps some great opportunity areas that are also to be identified. Umesh Goyal has also got a query from New Delhi. We do have time to take one more, so let's listen in.
Hi Udayan, this is Umesh Goyal from New Delhi. I have 240 shares of Colgate Palmolive, which I bought at an average price of 1680 with a long-term view. Given that the shares are trading at 1450, is it time to get rid of these shares, or should I invest more at the current levels to lower the average cost? Thank you.
Well, I wish I could say, Umesh, that you're onto a multi-bagger, but somehow I don't get that feeling that Colgate is the multi-bagger. India has exciting stocks at this point in time. And while there are many things which people have always loved about stocks like Colgate, which is its multinational pedigree, its pristine balance sheet, no debt, its high return ratios of maybe 70-80%. These are all great things, but there is no growth. The oral care business of Colgate is not growing. It's trying to supplement that with non-oral businesses and brands using the Palmolive brand. But I still think you're not going to get more than 4-5% volume growth annually from Colgate, which will translate into at best a 10% kind of earnings growth. Is it expensive for an MNC stock? Probably not. It trades at 32, 33, much less than some of the loftier cousins like HUL. but there is no great growth, which is why if you see it over a period of time, last 6-7 years, Colgate has not been a wealth creator despite its pedigree. So I would say that this is not a suggestion to either sell it tomorrow or buy more, but I would say that if you're looking for that quality and class of stocks, which a lot of people do, which is MNC, high return ratio, no debt, then I think you're better off looking at something like P&G Hygiene, which I think has better growth metrics than Colgate. But to cut a long story short, I would say Colgate is not going to be a great growth stock going forward.
Then, do you feel consumption actually, when I talk about staples, will actually see any kind of interest in 2022, or will it wane?
It's a tough one, Abha, because I think the lower end of the pyramid is still hurting. I know there's a lot of excitement about the stock market and what's happening in the cities, but if you just go down one notch, I think in the semi-urban areas or villages, people are hurting, and they also contribute to the consumption basket. So I think you have to be very careful about what you're buying in consumption. If you're buying a paints company because there's a paints and real estate recovery in the cities, go ahead by all means. But if you're buying a small ticket rural consumption item, then I think you would need to be careful. So I would be careful of the names like Colgate, Britannia, even Dabur or Marico, probably even HUL. Never been a fond of ITC. But there are consumption themes which are not FMCG companies, which might continue to come back strongly in 2022. But low-end staples, I would be a bit cautious about.
If you like the video, do like, comment, share and subscribe.